A very good morning to Madam and my group mates from Group 1. My name is VIMELJIT KAUR, and we have Nur HAZWANI, Anis NAJWA, Nur Afiqah, and INTAN SHAZLEEN. So for our question is discuss the history of the abolishment of Takaful Act 1984 and the introduction of Izzah 2013 in Takaful law. So our contents are as follows. I'll pass to my next presenter.
Thank you very much, Vimel. So for the introduction, Takaful is a form of Islamic insurance which participants pay money to a fund scheme designed to safeguard each other from future loss or injury. Takaful insurance is based on Sharia that describes how people are responsible for cooperating and protecting each other. Islamic insurance shall be differentiated from commercial insurance as it is free from prohibited elements in Islam. Takaful insurance providers were developed as an alternative to conventional insurance companies, which are considered to violate Islamic prohibitions on the theories of interest, riba, uncertainty, al-ghara, and gambling, al-maisir. So currently, Takaful has been applied by Muslims all over the globe, including Malaysia, as it brings a lot of advantages to both parties, the insured and the insurer, such as sharing financial losses to assist each other. This is a great foundation between the Muslims, as it is clearly described by Allah SWT in Surah Al-Ma'idah, verse 2. So in Malaysia, the laws regulating Islamic insurance can be seen under Takaful Act 1984 and Islamic Financial Services Act or IFSA 2013. Therefore, the objective of this presentation are to discuss the history of the abolishment of the Takaful Act 1984 and also the introduction of IFSA 2013 in Takaful law, as well as to highlight the differences between these two statutes in applying the application of Takaful in Malaysia. Moving on to the content. So the first content we discuss about the history of the Takaful Act 1984. So the establishment of Islamic insurance in Malaysia in the early 1980s was encouraged by the Muslim public's need for Sharia compliance to replace conventional insurance, and also to strengthen the service of Islamic Bank, which was founded in 1983. It was largely sparked by a resolution issued by the Malaysian National Fatwa Committee, clarified that life insurance in its current form is a void contract due to the existence of the elements of ghara, uncertainty, riba, usury, and maisir, gambling. So, following the task force guidance, the Takaful Act was passed in 1984, and the first Takaful operator registered in Malaysia was in November 1984. So during this time, the main objective was to establish the corporation's basic services. It also calls for the formation of Sharia committees to verify that the Takaful operators' business practices are indeed in accordance with Sharia standards. So I will pass to the next presenter.
So moving on to the application of Takaful Act 1984 on Takaful. Next. Malaysia is recognised as the founder of Islamic insurance of Takaful in Southeast Asia by introducing the Takaful Act in 1984 and incorporating the first Takaful operator, which is Syarikat Takaful Malaysia in 1984. And according to Section 8 of Takaful Act 1984, it stated that Malaysia Takaful operators must be supervised by the Sharia Advisory Councils, also known as Sharia Supervisory Councils, to advise the operators on their Takaful business to ensure that do not involve in any element which is not approved by Sharia. Takaful Act 1984 were established to promote the industry towards a degree of growth and development at the mainstream of Malaysia, and global insurance industry. And this act also provides for mutual financial aid and assistance to the participants in case of need, where the participants mutually agree contribute for that purpose. So there are two features of the in Takaful Act 1984, which is the inclusion of beneficiaries and the proper claimant. In inclusion of beneficiaries, Takaful Act 1984 limits the recipient of Takaful benefits to the participants only. And if the participant dies, then he or she will not receive the Takaful benefits, but his or her beneficiaries will receive it. This act also describes the payment of mutual financial aid to the participants in case of need, but the case of need is not specifically defined. In proper claimant, Takaful Act 1984 does not provide an express rule on nomination. And according to Section 65 of Takaful Act 1984, also stated that payment of Takaful benefits may be made to a proper claimant. A proper claimant is a person who claims to be entitled to the Takaful benefits or executor of the deceased, or who claims to be entitled to such benefits under the relevant law.
Next, for the history of abolishment of Takaful Act 1984, Takaful Act 1984 was gazetted for publication on December 31st, 1984 and has came into force on January 1st, 1985. The main purpose of this act was to provide for regulation on Takaful businesses. Takaful Act 1984 and Islamic Banking Act 1983 was repealed and replaced by Islamic Financial Services Act on 30th June 2013. Takaful Act 1984 was replaced for a more comprehensive and adequate regulation to take place in order to support the rapid growth of Takaful industry. Taking into example of the exclusive definition of Takaful provided by the Izzah 2013, it is crystal clear that the definition of Takaful provided in Takaful Act 1984 has loopholes which were filled by Izzah 2013. This is due to the fact that Takaful Act 1984 was silent on the definition of common fund, which can be said as Tabarruk fund or participant risk fund. Furthermore, with regards to the payment of Takaful benefits, the Takaful Act 1984 did not provide with explicit details. Takaful Act 1984 failed to guide the Takaful operators in regulating the Takaful benefits, and this led to an abolishment of the Act.
Next, we move to the introduction of IFSA 2013. Islamic Financial Services Act, or IFSA, was introduced in 2013 and published in the Government Gazette on 22nd of March 2013 in order to provide for the regulation and supervision of Islamic financial institutions with the aim of promoting Sharia compliance and financial stability. IFSA was a recommendation of the Financial Sector Blueprint 2011 until 2002, which is issued by the Bank Negara Malaysia. This Act came into existence after the Islamic Banking Act 1983, the Takaful Act, the Payment System Act, and the Exchange Control Act 1953 was repealed. The reason why these acts were repealed are because of, first, due to non-clear distinction provided between deposit and investment accounts. Second, Islamic banks did not clearly differentiate between risk sharing and risk transfer activities. And third, Murabahah investment accounts, for instance, were ambiguously treated as deposits and liabilities. This Act also consists of 18 parts, which provided 291 sections and 16 schedules, emphasized 4 keys of dimension, namely Sharia governance framework, Sharia standard for each Islamic financial product, preemptive measures to address issues that may affect the interests of depositors and policyholders, and the effective functioning of Islamic financial mediation. The objective of ISLAM is to redefine Islamic deposit and classify investment accounts as non-principal guaranteed, while deposit account as principal guaranteed. Next, to provide for the implementation of the risks of non-compliance with Sharia principle and impose legal duties on Islamic financial institutions in order to ensure that their objective, operation, and business activities comply with Sharia principle. And next, to introduce the investment account, which allow more chance for Islamic financial institutions to use true sale credit financing instruments that will lead to a greater level of flexibility in terms of investment criteria.
Next, moving to the application of Izzah 2013 on Takaful. Next slide. One, the application could be seen in the inclusions of the beneficiaries, where unlike the application in Takaful Act, Izzah 2013 has fulfilled the loophole for the issue of beneficiaries of the Takaful participant, where the beneficiaries will act as a recipient of the Takaful benefits upon the occurrence of the pre-agreed events. So, the Izzah 2013 definition of Takaful fixed this distinction by expressing that the case of need alludes to the pre-agreed occasions as commonly concurred within the Takaful certificates. Moving to the next slide. The second application could be seen in the minimum capital requirements, where previously Takaful Act implemented a minimum capital requirement of RM 100 million in order to open a Takaful business. So after the application of Izzah 2013, the minimum capital requirement will instead be specified by the regulator. So it will be depends on the regulator on how much the minimum capital requirements for the party. So in spite of the fact that the genuine effect of this alteration, this principle-based control within the Izzah 2013 may donate a few scope of controllers to issue capital necessities that could depend on the nature and complexity of the business. So this shows that Izzah 2013 had promoted flexibility compared to Takaful Act. The third application could be seen in the proper claimant, where similar like Takaful Act, the definition of proper claimant is same for Izzah 2013. However, Izzah 2013 provide extra definition of proper claimant, which also included parental guardian of an incompetent nominee or an assignee, or who claims to be otherwise entitled to the Takaful benefits under the relevant law. So in addition, Izzah 2013 also acknowledged the contract of assignment as an instrument for the Takaful participant to convey the Takaful benefits to beneficiary after the death of the assigner. So we could see that the application under the Izzah 2013 is more wider. So moving on to the differences between Takaful Act 1984 and Izzah 2013, just like we have discussed earlier, the main differences are the minimum capital requirements, the inclusions of beneficiaries, and the proper claimant.
So for the conclusion, it can be concluded that the distinctions between the Takaful Act 1984 and Izzah 2013 can be seen where the latter having a wider application on Takaful law in Malaysia. Izzah 2013 offers greater assurance and public confidence in the framework, with stronger emphasis on corporate responsibility and customer welfare to guarantee fairness, efficient complaint management, and dispute resolution. So in our point of view, it can be submitted that Takaful is very useful in our life as it acts as a security, especially during this pandemic, COVID-19, where the numerous unforeseeable risks may occur. With that, we end our presentation. Thank you.